Yo, what's up, guys? Today we're gonna take a moment to answer a question that I've been getting a lot lately, which is the difference between the markets that exist. So before we jump into the lesson, we'll take a quick look at this chart here, and you can see that we're looking at a Bitcoin chart. However, there are multiple different Bitcoin tickers, and they have their own price points. So at the end of this short little video, we're gonna understand why this exists. So jumping right into it, there are two different types of markets. There is the spot and the derivative market. The spot market is a market that most people are already familiar with. That is where you buy or sell an asset and you get physical delivery. So if I buy one Bitcoin, I'm physically getting one Bitcoin delivered to my wallet, and then I can move that Bitcoin from wallet to wallet, and I actually own it. Whereas with derivatives, it's just a contract, an agreement between a buyer and seller that has value associated with it, and it's mechanism purely for trading. And an important thing to point out before we get into identifying what derivatives there are is that spot and derivatives are their own markets in that they all every exchange and every contract has its own individual order book, which means that they move um, on their own, right? So everything's tethered to itself, right? So if we look at the Bitcoin market, for instance, all the little Bitcoin markets that exist are all going to be tethered to the main spot market, but a derivative contract on exchange A can move differently from a derivative on exchange B because, like I said, they have their own order book and thus they're their own market. So there's mechanisms in place to keep price tethered because you don't want derivatives and spots to be going in opposite directions or anything, right? Because ultimately they still represent the value behind the same asset. And apart from the mechanisms that exist within the contracts themselves to keep price tethered, also you can rely heavily on the larger participants to keep prices balanced because, for instance, if there's a large discrepancy between a derivative and a spot market, a larger participant can arbitrage that out. So they'll make money in the process of making the market more efficient, right? So if Bitcoin spot is at 35,000 and futures contract is at 45,000, right? They can long spot short derivative and collect a premium in between, and they're getting paid to make the market more efficient. So a little bit of a tangent, but it all ties into the same lesson here. So just go ahead and jump into the different types of derivatives that exist. The main one is going to be a futures contract. This is generally where people should start when they are dipping their toes into understanding these things. You're going to want to pay attention to spot and perpetuals. A futures contract, or I meant to say futures and perpetuals, not spot. So a futures contract is an agreement between a buyer and seller to be settled at a later date, which basically just means that the contracts are normally going to be quarterly. Some of them are going to be weekly, but the main contracts that people trade that actually have large open interest behind them are going to be um, quarterly. So, like currently, the contracts that we have access to right now are June 25th. There is a September 24th, and there is a December, but I can't remember what the expiration is on that. We'll figure that out in a little bit. It's kind of irrelevant right now. But basically, what the takeaway here is that eventually the contract that you have chosen to take a position on will expire, and you have the option to either roll over into another contract or you can completely just exit the trade in general. It's important to pay attention to when these contracts expire because normally when derivatives expire, they normally line up so they expire around the same time as one another. And normally it's going to lead to some sort of either speculation around the expiration or just increased volatility because when you have a lot of money tied up in these contracts and all of a sudden over the next 2 weeks people have to exit them, um, there's all this new money floating around. So interesting dynamic that can play out there. So to summarize, a futures contract is just an agreement between a buyer and seller to settle at a later date. And the fact that the expiration, so the fact that every quarter that the contract is going to cease to exist, that is the main mechanism that is tying spot pricing to futures pricing. Now, you're often going to see that spot pricing is going to not be the same as futures because a future is just that, right? You're making a directional bet on the price of the asset in the future. So they're normally going to either be ahead of or behind spot based off of whether or not we're bullish or bearish overall. So moving on to perpetuals. Perpetuals are probably the contract that people should be uh, dipping their toes into first, just because it's the most simple and there's the least risk, I'd say. Because apart from being directionally wrong, the only thing you have to worry about with a perpetual contract is the funding, and funding is a pretty simple thing. It's the mechanism by which perpetuals tether the price of the perpetual contract to spot. Um, and how this works is that when spot is ahead of the perpetual, you have negative funding, and shorts are going to pay longs. But when spot price is behind the perpetuals and you have positive funding, and that's where longs are going to pay shorts. So standard funding is 0.01% or 1 basis point. However, this can move up and down based off of the outlook of the market, because you'll have times when spot has large differences between a large premium between the spot price and the perpetual contract, and those are the moments where the funding is going to get more extreme, right? You can have funding, on less liquid coins all the way up to 0.5% or 0.75%, and you can definitely build strategies around that. So to summarize, it's a directional contract with no expiration date, and it's definitely the easiest to use because all you really have to worry about is to make sure that the trade that you're going to be uh, executing, that the profit outweighs the small funding rate that you're going to be paying, which, like I said, is 0.01% by default. So it's not that difficult to outpace funding. However, it's definitely something to be aware of, and there's strong arguments as to why perpetuals should be used a specific way, and I'll get to that at the very end. So the last contract type we're going to talk about is an options contract, and option contracts are definitely the most complicated of the mechanisms that we're talking about today, just because you have a lot more factors that are called the Greeks that play into how your P&L will play out. And for this reason, I would say that very few people should be even touching an option. Really, you want to get to the point where you're a little bit more of a sophisticated market participant before you really want to be touching them. But in essence, they're a pretty straightforward concept that it's just an agreement between a buyer and seller to facilitate a trade in the future, right? So I can buy a call, so I have a right to buy the asset at a later date, right? So if I buy a call on September 25th, that lets me, when September 25th rolls around, I have the right to buy that asset or choose not to, right? That's the option aspect of it. I could choose to execute or choose not to. Um, and because of this, um, options are great when it comes to directional plays, um, mainly because you don't have the same type of risks, right? So your risks are the Greeks, right? Where a traditional um, position, your risk is being directionally wrong and getting stopped or liquidated, which is definitely an issue for futures and perpetuals. But for options, there is no real mechanism for liquidation that I'm aware of, and your risk is based around the Greeks. So basically, with options, you can lever up without being susceptible to the chop hurting you in the same way, right? If you take a leverage position on a futures contract and you want to sit in it for 2 months, that price action between entry and exit can really get in the way of you making any money. So with a options contract, you can avoid those types of pitfalls. Um, so before we summarize what they're all used for, or what in my opinion they should be used for, we'll close it out with idea that these trading mechanisms are mostly looked at by retail participants for directional bias, right? So I think X is going to go to Y, or I think it's going to go to Z, or whatever. And people, punt around these ideas and take gambles. But my favorite thing to use these for, especially nowadays in the momentum-driven market that we have now, is for reducing risk, right? So the best example I can give is that if you own one Bitcoin on the spot market, so you're long one Bitcoin via spot, and you had a comfy entry, let's say you bought at 14K and you realize that we're at 50K, and you have reasons to be worried about potential drawdown, you can just take your spot Bitcoin to a futures market, and there's a type of contract called the inverse future, and that is where we use the Bitcoin itself as collateral instead of Tether. There's two market types within derivatives. There's the USDT collateralized, so you use a stable coin as collateral on your position, but then there's also the inverse contracts that use the actual spot coin itself as collateral. So a major one is the Bitcoin one. So your play to reduce risk is that you take your spot Bitcoin and you go to the inverse collateral future contract and short. And now it's what's called as being delta neutral, because you don't have directional risk anymore, right? If I'm long one Bitcoin from 14K and I'm short one Bitcoin from 50K, it means I basically locked in the value of my Bitcoin at 50K, that no matter what, if Bitcoin goes up or goes down, now my value stays the same. Um, so I'm not really going to be out here advocating that people with less experience try to hedge and control their risk in these ways, but as you get more advanced, this is definitely the kind of thing you want to be looking at. So for a little bit more context and background based off of the current market environment, is that something that I run into personally with that is that uh, I got really, really good entries on a lot of my swing trades, and it's really hard for me personally to part with a position when I know it's pretty unlikely that I'll ever get that entry ever again. So the best thing to do is to just reduce risk at um, trouble areas by shorting. And if you have multiple altcoins, which the larger the trader you are, the more altcoins you can sustain. If you're a smaller 4 or 5 figure position um, trader, you should probably be having less altcoins. But the point I'm trying to get at is that you can essentially, instead of shorting, right, like at one point recently I had 13 altcoins, and instead of hedging 13 different positions, you just go and short ETH for the entire value of that, because essentially ETH is going to mimic mostly what the altcoin market does. So to end our little cheat sheet that we have here, I wanted to end with the point of what the contract timeline should be. And this is opinion. However, I doubt that there's really anybody that's going to disagree with this approach, that you should use perpetual contracts for shorter term and intraday plays, right? So if you're going to hold a position for minutes, hours, or a couple of days, you're going to want to lean towards a perpetual contract, because there's not going to be a premium, right? That it's far more likely that the perpetual contract is going to be essentially the same price as spot. And if you're only holding it for hours or a couple of days, you can survive the pain of paying the funding. Um, and if you're confident that you can take a position on perpetual and have funding be in your favor the majority of time, then you definitely can use a perpetual contract. So for instance, when we were extremely, market was super bullish above 50K, you could have shorted the perpetual contract up there to hedge, and you would have been getting paid funding the entire time because we were so bullish at that point. Um, Yeah, but moving on to futures and options, right? Those are going to be your mechanisms for medium and longer term swing trades, right? So if your time horizon is months, half a year, anything like that, maybe not quite a year, but definitely in the multi-month range. Futures and options are going to be your best options there because they're going to have good liquidity. And yeah, I mean, as I explained earlier, um, I personally really only trade futures myself, but I do think options are actually better for this type of trading because what I said earlier that you can, a futures contract is nice because you can have the same type of directional exposure as a perpetual without paying the funding. But an options contract is even better because you don't pay funding and you're not at risk of liquidation or getting stopped, right? So when you have that high conviction behind a trade, if you take it on an options contract, um, it's normally going to work out better for you, I think, assuming that you're correct and not wrong. Um, and then the last market is spot, and spot yeah, definitely is for positional trading and investing, right? So when you want to buy something and forget about it for long, long periods of time, right? Months, years, you're going to want to take spot, right? There isn't really going to be any derivative options for you to hold for 5 years. And you would be susceptible to getting stopped, getting liquidated, getting squeezed every day that you have that derivative contract open. But when you take the spot position instead, your risk is really, you know, essentially your risk is the idea that the asset goes to zero and your holding goes to zero. But as long as you're taking good bets, that really shouldn't be an issue for you. Yeah, so we're gonna leave it at that for our little cheat sheet. We'll go over to our premium, and now that we understand this idea that there's multiple markets, right? You can see that we have in black is Coinbase, so that's our main spot market that we're using to track. And in orange, which you can't really see here, but in orange that is Bybit, I believe, which is the perpetual I was using to track. So right there we have our spot market and we have our perpetual market. And when you zoom in really close, you can see how, I guess we could zoom in real quick. You can see the relationship between how the orange and the black, right, the perpetual and the spot, they're not always at the same price, right? A lot of times you get heavy selling and the perpetual is going to go below spot and so on and so forth. But I did want to keep this a little higher time frame here and mostly talk about, let's see, let's get all this hold price action in here, get the start of the breakdown. So you can see spot and perpetual, and then everything above it in this instance is going to be our futures contracts, right? So we have our June, our 060625. So there's two different June contracts there. We have our 6 month contract, which is going to be September. So we have two Septembers, we have three Junes, and then we have one December from FTX, which is definitely one of the contracts I've really liked personally trading a lot lately. And I mean, simple explanation for why I prefer a higher time frame futures contract is just because the premiums are going to get so much more out of whack, right? When you're talking about a contract that's 7 months, in the future is when we expire, you're going to get a lot more discrepancy, a lot larger premium between spot and futures. So for example, right, look at when Bitcoin was 55K, 57K, the futures contract for December was 66K. So if you were either bearish or had a reason to protect your underlying long exposure, you could have taken a short on the December contract, and that premium gives you a lot more wiggle room if you're wrong, because it's pretty inherent in a market, like I said at the beginning of this video, with the larger arbitrage type participants, that they're going to arb out these inefficiencies eventually. It's pretty difficult with crypto because there just isn't enough money in the system to do it. And also, when you're the arbitrage guy, you're really only getting 20-30% a year, and 20-30% a year in crypto is considered underperforming. So those two factors of not being enough cash and not really being worth the reward. There's, I want to say there's a reward there, but there's essentially no risk if you do it properly. But anyways, yeah, just we'll close it out here. You can see all the different contract types, and you know, how to explain it. You want to look when you're looking for shorts, you want to look for moments where there's a large premium, where to the upside, right, where the futures contracts are way above uh, the spot markets, and vice versa, right? If you want to look for longs, these are the areas where you logically want to look for longs, right, when the premium's tight. I'm not saying it's going to go up here, and this isn't a reason for it to go up just because the premiums have thinned out, but it's definitely um, a factor as to why you might want to look to get positioned long, right? Because the premiums have dissipated. I'm sure there's times in the past I can find where, you know, let's see, we had a top here, 58K top, market marks down. You could see that the premiums got tighter in these sell-offs, which then led to more of a buying wave. And yeah, I think we'll leave it at that. I hope that did explain some of it. I know there was a lot of technical talk, um, but that's just, I mean, how it goes. Unfortunately, there's a reason why there's all the technical talk. It's meant to make it more difficult for people to learn these topics. But once you understand the terminology, the ideas can become pretty simple to grasp. It's not nearly as complicated as it all sounds or looks. But all right, guys, we'll leave it at that. Everyone have a good one.